And without further ado, let's get going on what we're going to talk about today. So, Elvis, you might want to turn your camera off. Perfect. All right. So what's the day going to be? No, it's not going to be 3 hours, unfortunately for you and us. But today we're going to give you an introduction to the Platinum Growth Fund, why we did it, what this means in our model portfolios. Zaw is going to do an in-depth look at some of the holdings and the managers, what we expect to happen with this fund and why we have it. And then Elvis has brought his crystal ball today, and he will be making sure that we know exactly what's going to happen over the next 3 to 6 months in the world and in the equity markets. Throughout the day, we encourage you, we have a chat. It's posted to everyone, so please keep it clean. And please do ask questions. We're really interested in those questions. There's lots of people in the background to answer them today. The other thing, we'd be really interested to get your feedback after the webinar. We want to do more of these webinars. I think it's a great way in these crazy times to communicate. Maybe a lot more interesting than us sending you long emails. So we'd really like to know if this is a format that you enjoy and if you want to participate, perhaps doing shorter but more frequent webinars on a variety of investment topics and financial planning. To that end, we'd also really like to know what you'd like to see more of, what interests you if the team is doing a webinar. So questions, comments, and concerns on the chat, and we will have a replay that we'll post to the website after. So why did we do this? What is this, and how does it affect you? It's been a long time coming for the practice. I started looking at launching an institutional fund or a pool over a decade ago. Why would you do this? What the fund allows us to do is in one holding, one ticker, one security symbol in your account, it allows us to aggregate and get access to a number of the top equity fund managers of our choosing, all in one holding. Why this works and why this would be done is because it allows us to rebalance a lot faster, monitor the performance of those equity managers versus a benchmark very quickly, make changes across a single account instead of hundreds or even thousands. And it really, really simplifies accounting and can save money. So all positives. So let's talk a little bit more about the why. So in your accounts in the past, let's think about how we manage your money. In your portfolios, because we are agnostic towards any specific type of security, because we are not paid by your holdings, you have often seen in the past one of three things: either an active manager in the form of another portfolio manager's fund, a passive investment structure like an index that tracks an entire sector, also known as an exchange traded fund, or directly holding securities, so directly holding a stock. And in the past, we might have had approximately 40% active managers and the remaining 60% equally broken up between individual stocks and index funds or ETFs. So the problem, not necessarily a huge problem, but the issue was in the space of the individual managers, each of those managers would send you a tax slip. We are able now to take all these top managers that we have analyzed because we have no compensation bias or proprietary product and put them into one fund. So that Platinum Growth Fund actually contains 7 of the top third-party managers in North America and 9 individual funds. So think of it as a basket that's diversified not only by manager, but by geography and sector across a number of different companies. How does that help with rebalancing and performance monitoring? So when we make changes historically, if we want to sell a fund, we would have to sell that fund in every single one of our clients' accounts. Now you think about the logistics and the trading processes that have to occur if you're managing over $500 million. This can take a lot of time. So in this case, the account is the Platinum Growth Fund. So when we want to sell a specific manager or buy a new manager, it's all done in a single account and can be done very quickly in a day. The other thing is something that you're all familiar with, which is buying in bulk. So when you looked at your statements before, you would notice that each of those managers is in what's called an F-class fund. That means it's a fee-only fund. We get no compensation for the fund. It's a stripped-down version of the fund compared to what you might buy as a retail investor. And that fund does not charge or have embedded commissions in it. So we're just able to see in the F-class what that fund is charging. Now, if you have a number of clients and each of those clients has $25,000 in the fund, when you aggregate it as a practice, you might have 10, 15, 25 million with that fund manager. But that fund manager looks across all of the different accounts we hold with them. So say we have it in 400 or 500 accounts. This way, we are going with one account and they give us bulk pricing. So we're able to negotiate discounts for you. In other words, to save money. These fee discounts are only available to large institutional investors. Traditionally, this has been places like a pension plan. So for those of you that have a defined benefit pension, this is very common. They'll go to a third-party manager and negotiate a lower fee on behalf of the pension because they're giving them a $10 million sleeve. Well, now we are that sleeve, and we can negotiate on your behalf to get you lower prices. Very easy then to see how that manager is comparing to a passive index. So for example, if we've got a US equity manager, we can easily compare them to the US stock market. And it allows us to quickly analyze on a continual basis how those managers are performing together based on their risk when put together and the expected return. Accounting is always a nightmare for every one of us that holds a non-registered cash account. Why? Because you get, as you know, a number of slips. You'll get slips from each fund trust that you hold in a non-registered account. So if we can reduce the number of slips you get, because now it's issued by the Platinum Growth Fund, as opposed to 7 to 9 other funds, well, we're going to save you time, stress, aggravation, and money. So you're going to get one T3 from this fund next year versus one T3 for every holding. This also can allow savings at tax time by reducing your accounting fees. And for those of you that, quite often say you don't get the T3s or they've gone missing, this will reduce your stress, hopefully a lot, come tax time. This goes to our cost advantages. So lower accounting fees, quite often some of the accountants now are charging a flat fee per slip. So if we used to have 9 funds, that would be $270, and now we could be down to $30 and a $240 savings come tax time. The other big one I alluded to is lower management fees. So we're able to negotiate very significant, sometimes up to 20% reduction in the F-class version fee for our new institutional version. These will easily cover the operating expenses we have to endure with the pool, and as that pool gets bigger, saves our clients even more money. We don't get any compensation from the pool, just like we never got any compensation from the funds. This is what large pension plans, massive family offices, and large brokerage firms will do. They'll aggregate the client accounts so that everybody looks to be part of a bigger pool. What is in it? So when you see it on your statement, it'll just show up as Platinum Growth Fund. But know that inside that fund, you have a number of different holdings. And we're going to go deeper into these holdings when Zaw takes over to discuss in depth some of those individual holdings. You'll recognize a lot of these names because almost all of them were already in your portfolios before. Now it just shows up as one line item. If you ever forget, you can ask us, and all of the advisors will be able to send you a nice document that shows you all of the internal holdings of the fund. But the way to easily look at it is this becomes your active stock sleeve. So it's active managers from a number of different sectors, a number of different companies, all together in one growth sleeve. Inside that growth sleeve, we get access to a number of different countries. So not just diversified by manager, but diversified by country. As we know, the United States is home to a lot of the largest companies in the world, so that tends to be the dominant geographic exposure. But it also contains Canadian companies, European zone companies, and companies outside of North America. We quite often hear about a manager's style. So whether that manager is looking for companies that are more focused on growth, or they're looking to buy companies that represent a better value based on their valuations, we have a balance here between companies that are growth or managers that are blending that style between value and growth. But primarily, this is going to be large cap blend as far as style goes. And the next way we've made sure it's diversified is by the sector. So it's not massively overweight compared to the index, any specific sector of companies. Because remember, the Platinum Growth Fund is primarily your stock or equity holding in your portfolio. So if you're a growth investor and you've got an investment policy that says 70% of your portfolio is going to be stocks, close to 30% of your overall portfolio could be in the Platinum Growth Fund because it represents a number of different active managers for you. So what about performance? Well, if it just gave us the same return as the market, then we would just buy the market. But what we're generally looking to do, in a perfect world, we want to give you all the upside of the markets and none of the downside of the markets. And that's what Elvis is going to show you how to do later. No, that's impossible. So what we really wanted to make sure that we could look at was how historically have these managers all performed when put together in a basket contained versus just potentially buying you an index like the S&P 500 and reminding you that the S&P 500 represents the largest 500 companies in the United States and generally in North America. So that's cheap. We can just buy all those companies. So if we do anything else, we're making a decision to be active. So what we're showing here is from February 1st to March 31st, the very quick and rapid pullback of the equity markets, and comparing that, which is the green line is just the overall market, the red line is our pool. So what you see is in this period of time, the stock market's dropped 20.6%. Look at the lower left-hand corner there. And this fund with these managers only dropped 13.97%. So even though it's all stocks, it protected you on the downside. So even if we could get a bunch of managers and put them together and it gave us more protection on the downside, but all of the upside potential of the markets, that is a massive win. In other words, if stocks go up 10, you go up 10. But if they go down 20, you only go down 14. Considering that this is just the stock component of your portfolio, this is the data is quite amazing for us to put these active managers together. Like I said, most of these managers you've already had in your portfolio. The difference now is that they're in one fund. And during the recovery, what we also saw was the return of our Platinum Growth Fund managers was 47.5, but the market did 45. So we outperformed on the upside and we protected money on the downside. Again, you would have had all these managers in your portfolio before, but now it'll just be in one fund. Okay. Reminding you that there is no increase in the management fees here. So one of the questions that we might get is, well, is this going to cost more? As I was saying, we've negotiated discounts from all these managers so that the management fee now is no different than it was before and will keep decreasing as the pool increases in size. So when we go back 3 years, it's very important to show how from November 2018 to November 2021, the average return of the funds inside this pool have been higher than the returns of the market. So an average of 21.37 versus 19.3 with significantly worse, lower risk. So a standard deviation or how much the fund goes up and down, of 13.49 versus 18.45. Thinking about that in a dollar percentage, if the equity market was down 13 in the worst month in that period of time, this fund would have only been down 10 because it's a number of different managers together. Okay, so with that, I'd like to turn it over to Zaw, and Zaw is going to explain some of the holdings that are in this fund, why we chose them, and for many of you, this will be a review because you've had these holdings in the past.
Thank you, Robert. Hi, everyone. So as Robert mentioned, most of the holdings we've already held for quite some time. There's actually only 3 new additions to the fund, to the pool, and I'll get to those in a second. So just briefly, the equity pool is divided into the North American sleeve, the global equity sleeve, the small cap sleeve, the emerging markets, and the infrastructure sleeve. So first I'll tackle the North American sleeve, which is 45% of the total pool. So the first fund in the North American sleeve is the Fidelity Canadian Opportunities Fund, which is a name that most of you are familiar with already because it is a core holding for us, and we've held it for quite some time. It is our main Canadian fund. It's a medium risk rated fund. It is entirely focused in Canada, as you can see, 86% Canadian equities, and it has a value-oriented contrarian strategy. So what that means is the fund manager looks for stocks that have kind of fallen out of favor a little bit because there might be some sort of temporary issue in their business model, and because of that, the stock is trading at a really good valuation. So the portfolio manager, Hugo Lavallee, who's been managing this fund since 2013, he looks for these opportunities, these pockets of opportunities in the Canadian market, buys them at a cheap valuation, waits for the businesses to turn around, then flips them for a higher valuation. He's been tremendously successful at this. The fund was launched in 2000, and it's just been outperformance for the past 2 decades. It's the best Canadian fund in the space. It won the Refinitiv Lipper Fund Award for 2021, which basically is like the Oscars of mutual funds, and it won the best Canadian fund out of all of its peers. So we love the track record, we love the fund manager, and we love Fidelity. I mean, what more can you say about Fidelity? It is one of the biggest asset managers in the world, and we get access to their world-class research team. So that's the Fidelity Canadian Opportunities Fund. Next up, we have the TD US Blue Chip Fund, which is another fund that you guys might be familiar with already. It was a core holding. It's some of our smaller models. It's a focus on the large and mid-cap American companies, names that household names like Alphabet, Amazon, Microsoft, Meta, formerly known as Facebook. So these are the leaders of the American economy. This fund, it's been one of our best performers. We love this fund because it allows us to get access to just probably the best companies in the world here. I mean, Amazon, Microsoft, Google, so on and so forth, Apple. But at the same time, the advisor that sub-manages this fund for TD is T. Rowe Price. T. Rowe Price is one of the best sub-advisors in the world. They have a leading research team, 336 analysts in 16 locals around the world. There are boots on the ground analyst team, meaning they actually go to the companies, talk to management, do site visits. They really, and they stick their necks out there because if you don't perform as an analyst for T. Rowe Price, you're going to be cut. So we really like that. Can't say much else about it. This is just, it's going to be a core holding going forward as well. So now we have the Dynamic Power American Growth. The Dynamic Power American Growth, it's a medium to high risk rating fund. And what it is, it allows us concentrated exposure to the manager's best ideas. It is mostly in the tech sector and consumer discretionary, and it is mostly American companies. The fund manager that runs it is somebody we've known for a while, we follow. He's kind of a rock star, as Robert would say, in the space. His name is Noah Blackstein, and Noah is really well known in the industry. He's been a subject matter expert at every financial news outlet when it comes to tech and growth stocks. He's our go-to guy for investments in cloud, AI, infotech, robotics, biotech, fintech, etc. Anything tech, no one knows it. Some of his best hits was purchasing Google in 2004, Apple in 2002, Square Payments, which you might have seen if you go to a restaurant. It's the little white things that you tap your card on. He bought it in 2016. So Noah has a great track record. These are really growth-oriented, concentrated fund manager. Let's see now. So now we move on to the global equity sleeve. The global equity sleeve is about 35% of the total pool. And the first fund in the global equity sleeve is the MACKENZIE Ivy Foreign Equity. Again, a fund that we've held for some time. We like this fund because it is medium to low risk. They have a concentrated exposure to large cap companies across the world. So it allows us to get exposure to companies outside of North America. These guys have the fund managers of this fund are cheap, and that's good. That's a good thing. And the reason what I mean when I say cheap is that they like to look for companies trading at really good valuations, really good multiples, and they're not going to overpay. They've always exercised patience in the past. They've waited. They look at these great companies and they've waited until the valuation was right, and then they would buy it. So they're patient. They don't like to chase the next up and coming growth stocks. People like say Kathy Wood, a name that you might be familiar with, who runs ARK Funds. She's a momentum-based investor. The guys that run MACKENZIE Ivy are the complete polar opposite of somebody like Kathy. We like this fund because, like I said, they are cheap. They have this great value tilt, but at the same time, if you notice, a lot of their holdings are in consumer staples. The consumer staples tend to hold up in terms of market in times of market downturns and in times of high inflation. So we really like this as kind of a hedge against inflation in our portfolio, and just to kind of balance out some of the more riskier investments that might be in it from names like Noah. Okay, next up, we got the AGF Global Select. Again, another fund that we've already held. It is a global-oriented fund. It is, again, a concentrated fund. It's medium risk rated. And again, it is kind of like Dynamic Power in that it is ran by a really, really good and capable fund manager who's really known for unearthing great value, but on a global spectrum. So think of it as Dynamic Power American Growth, but only on a global basis. The guy that runs it, Tony Danua, he's been running this since 2013. Prior to Tony's tenure, this fund wasn't performing very well. And when Tony took over, since 2013, he has outperformed all of his peers and the benchmark as well. So Tony has an excellent track record in the space. He has sat through multiple economic cycles. We have faith in his picks, and we will continue to hold them going forward. Okay, so this is a first new addition to our funds. It's the Global Equity Private Pool. And what it is it's basically 4 funds ran by 4 separate fund managers, 4 separate strategies. Those strategies, so it is a medium risk rated fund. Those 4 strategies are concentrated growth, opportunistic value, core holdings, and equity income. So there's a little bit of each. One of the growth guy, the guy who runs the growth strategy is, again, Noah Blackstein. We really like this fund. It's a new addition to our fund because, again, it gives us global scope and it gives us a little bit of everything. And there's certain little technical things that I like about this fund personally. For example, it's got high active share. So active share basically means that this fund is being managed actively. That's what we're paying these guys for. So we want to see active managers. We don't want to see guys that are just riding the market. Anybody can if you have just tracked the NASDAQ for the past 3 years, you would have done fantastically. But that's the NASDAQ doing all the work for you. You didn't have to pick a stock. But these guys are actually picking stocks and standing by their convictions, and it's reflected in their high active share. Another thing I like is their upside capture is 107%. So basically, when a market's going up, let's say market goes up 100 points, they're going to do 107 points. And their downside capture is 91. So the market drops 100 points, they'll only drop 91 points. So more on the upside, lower on the downside. I really like these guys, and I'm excited to see how they're going to perform going forward. So small caps, small cap opportunities is the only fund in our small cap sleeve, and that's 7.5% of the total pool. It's another brand new addition. This is a Canada-focused concentrated exposure to the small and micro caps. So small and micro caps are basically these guys. Chances, well, Aritzia is not really a small cap anymore, but for the most part, it's going to be stocks that most people on the streets have never heard of. They just started, but they have excellent business models, great management teams, and great track record of execution, and you're going to see them take off. So this guy, David Barr, who runs this fund, he has a great track record of picking out these undervalued companies, and the reason they're undervalued is because they're so new. The market hasn't given them a chance yet, so he scours the market for it, particularly in Canada, which is especially hard because all the tech, all the interesting stuff occurs down in the States, but Dave Barr focuses on Canada. He picks these great small cap names. He buys them really attractive valuations, and he goes along for the ride. So to give you an example of his track record, since the fund's inception, if you had placed $10,000 in this fund, it would have grown to $90,000. So it's a nine-bagger, and that is extremely impressive because this is Canada, and it's not Silicon Valley down the States where there's a startup, a billion-dollar unicorn startup around every corner. This is Canada, and yeah, he's just managed to do it. So David Barr is also, PENDER is also a Vancouver-based company, so he's literally across a bridge from us, and we've been working with him, we've been chatting with him for quite some time. So we do have access to him and his team, figuratively and literally. So that's a big plus for us. Emerging markets, another new fund, Fidelity Emerging Markets. Every balanced portfolio needs a bit of emerging market exposure, namely because there's just certain, the way the world is going, for example, in 2025, 28% of global GDP is going to be contributed to China, 13% to India. So we really do want to get in on these economies, get in on these companies. And you'll see names like Tencent Holdings, Samsung, everybody knows Samsung, and so on and so forth, Alibaba. These are great companies from across the world. This fund, Fidelity Emerging Markets, replace our BMO Asian Growth and Income Fund. And the reason it replaced it is because simply it outperforms it. It's the best emerging market fund on the market, and we have access to Fidelity's great analyst team. So nothing much more to say about it. It's just we need emerging market exposure, and there's no better way to get it than through this fund. Finally, we have the Russell Global Infrastructure Fund. Again, it's something we've held for some time in our bigger models. We needed infrastructure assets because infrastructure assets tend to be an inflation hedge. So in times of inflation, infrastructure companies that run things like airports, toll roads, parking lots, ports, are able to pass on the higher costs back to the consumer. And so it is kind of like an inflation hedge. Secondly, they do have very, very steady cash flows, regardless of the economic cycle. So it does give you income in forms of dividends or interest income from this fund. So we do like that. It's our inflation hedge. We've worked with Russell for quite some time. We know we trust the portfolio managers. We trust the sub-advisors on this fund. It's a global scope, so you're well diversified. And yeah, it's just an overall a good fund. It gives us access to an asset class that we think should be needed in a well-balanced portfolio. So that's it for me. I'm going to pass this off to Elvis, but I'll be checking the chat. If you have any questions, I'll be sure quickly answer it, and also feel free to shoot me an email at any time. Be happy to answer any of your questions. And here's Elvis with the tea leaves.
Thanks, Doc. And thank you all for joining us on this webinar. My presentation is going to go over some interesting numbers first, and then our views on the market later. It goes without saying that this has been a phenomenal year for the markets, with gains of 23% to 25% so far this year in Canada and the US. There are 4 stock market indices shown in this chart, which goes back 2 years. The blue line shows the S&P 500. The orange shows the MSCI World Index. Green shows our Canadian TSX. And the yellow shows the European Eurostoxx 50 index. So as you can see, the S&P 500 has been the best performer over the last 2 years. followed by the MSCI index, the TSX, and then the Euro Stock Index. Now, a quick recap of the MSCI World Index. It's an index of 23 developed nations. The US has the biggest weight by far at 68.5%, followed by Japan at 6.5%. Canada has only a 3.3% weight in this index. So the obvious lesson from this is, you need to diversify well beyond Canada, which is what we've been doing for many years. The US dominates this global index, and in fact, the global market, because the biggest companies in the world are all American. The 5 biggest companies in the world by market cap are Apple, Microsoft, Google, Amazon, and Tesla, and they all exceed $1 trillion in market cap. Apple and Microsoft alone are over $2.5 trillion each in terms of market capitalization. And by way of comparison, the entire TSX index of 233 companies has a market cap of only $3 trillion. Now, as you can see, these 4 indices have almost doubled, or in the case of the S&P 500, more than doubled, from their March 2020 lows. This chart covers the last 2 years, which includes a period just before the pandemic. So since November 2019, the S&P 500 is up 50%, and the TSX is up about half as much at 27%. Now, when we try to gauge investors' risk appetite or the willingness of people to take on risk, we look at things like crude oil, precious metals, currencies, and now, of course, cryptocurrencies. So on that basis, crude oil has done really well this year. Bitcoin has doubled in price, but gold and silver are down marginally, and the Canadian dollar is almost unchanged this year. This last point about the Canadian dollar is an interesting one. When we had a previous seminar in May, the CAD was trading at 83 US cents, and it's now 5% lower at about 79 US cents. We really like to see the CAD around this level, at or below 80 cents to the US dollar. This is because about 20% of a balanced growth model, which is a pension portfolio, is held in US dollars. Now, holding part of the portfolio in US dollars is an important counterweight to market volatility. When the markets are very strong, the CAD appreciates, and you pay the price a little bit because it reduces your portfolio return by a tiny bit. But the real benefit is when markets plunge, because that's when the Canadian dollar weakens and the USD part of the portfolio suddenly looks really good, and it provides a really good downside cushion for our portfolios. So, given that the TSX is up 23% year to date, what sectors are doing well? Well, obviously energy, because of the surge in oil and natural gas prices, followed by technology. The technology sector in Canada is an interesting one because it's dominated by Shopify, which is now the biggest company by far in Canada, exceeding the market cap of the Royal Bank by, I think, $50 billion or so. The financial sector has also done well this year, and that's mainly Canadian banks and insurance companies, which tend to do well as yields go up. On the lagging side, utilities and materials have lagged, and the one sector that is down for the year is healthcare, and that's because of the sell-off in cannabis companies. The chart on the right shows the composition of the TSX. And as we've said before, the fact that sectors like technology, industrials, communication services, utilities now make up 1/3 of the index is a good thing because it might lead to more stable returns from the TSX in future. Reducing the weight of sectors like financials and commodities, which go up and down the economic cycle, should make the index less volatile, and that's really a positive. So now to understand how the markets may perform, we need to have some sense of what the economy is going to do. If economic growth or GDP grows, then companies' profits go up, and that leads the market higher. But if we have a recession and companies' profits shrink or turn to losses, the markets will retreat. So for example, in March of 2020, we saw the markets plunge in a matter of weeks because of the fears of a global recession caused by COVID. Fortunately, that recession in the US was the shortest in history, lasting all of 2 months, and the subsequent recovery has taken corporate profits to new records. These charts are from the IMF's World Economic Outlook that was released in October. The chart on the left shows that global growth is forecast to slow down slightly to about 5% in 2022, after rebounding by almost 6% this year. The chart on the right shows that growth next year will be a little bit divergent, in the sense that it will be quite strong in the developed nations and in Asia, but less so in Latin America and Africa. So here are some takeaways from the IMF report. The table on the left shows you growth projections for individual regions and key nations. And for us in Canada, obviously, the most important takeaway from this table is the forecast for our economy, which is expected to grow at a solid 4.9% in 2022. So there's very little risk of a recession at this point. We mentioned earlier that growth prospects are a bit divergent, and that's largely because of vaccine access. We are extremely fortunate to live in a country where the vast majority of the population is vaccinated, and the most vulnerable, like people who are immunocompromised or the elderly, are now getting booster shots. But the reality is that in the poorer parts of the world, only a small percentage of the population is vaccinated. The World Health Organization recently called this disparity in vaccine access a scandal, because there are 6 times more booster shots being given globally in the richer nations compared to primary doses in the low-income countries. The IMF rightly calls this a risk to global growth because COVID is a global problem. The risk is that we may get more aggressive COVID variants before most of the world is vaccinated. The other risk flagged by the IMF is inflation, where the obvious risk is that inflation may trend higher, especially if the supply chain issues that have been in the headlines recently continue. Because these supply chain problems are cropping up at a time when global demand for goods is extremely strong. Overall, though, this demand also translates into really solid corporate earnings. Now, mind you, this year in 2021, we saw a huge rebound from the COVID-affected earnings of last year. And quite naturally, that earnings growth is going to slow down in 2022. So to get some idea of what the index will do next year, indexes like the TSX of the Canadian or the S&P 500, we look at the earnings estimates for all companies on the TSX. For example, we get these estimates from providers like FactSet or Bloomberg. And that's what's shown up in the very top row. It's a little bit blurry, but I hope you can read it. And then we multiply that number by a figure called the price earnings ratio or the PE ratio to get a target level for the index. So here's a simple example. If you have a stock that is expected to earn $5 per share next year or $5 in EPS, and you give it a PE multiple of 20, then your target price for the stock is $100. You can also work backwards to figure out whether a stock or an index is trading higher or lower than its PE multiple, its historical PE multiple. So for the TSX, if you look at these numbers, you can see that it's got an EPS estimate of $1,368 for 2021. The index is now trading close to it around 21,500. So that gives it a forward PE ratio. And we use the term forward because you're looking at forecast earnings for 2021, because you're in November, 2021 is not done yet. So the forward PE ratio for the TSX is about 15.7, which is right in line with its historical multiple of about 16 times. For the S&P 500, that forward multiple, based on this year's EPS of $203 and its current level about 4,700, it's about 23.2 times. So that forward P of 23, it's a little about the historical P ratio of about 20 times. Now here's the thing. Index forecasts, or what the street thinks the markets will do next year, they've actually risen 10% since our May update. At the time of our May update, strategic target levels were at 22,000 for the TSX and 4,750 for the S&P 500. So those have actually proven to be pretty accurate, given that we are now at 21,500 for the TSX and 4,700 for the S&P respectively. Now those forecasts in the last 6 months, they've gone up by about 10%. So currently, the street expects the TSX to finish next year at about 24,225 and at about 5,200 for the S&P 500. So if you look at the upside from these levels, it's about a 13% gain for the TSX and about 10% for the S&P. If you add in the dividend yield to get a total return number, forecast returns for the TSX next year are about 15% and about 11% for the S&P 500. So good, solid numbers. Now let's turn to what we call COVID consequences, since COVID has been the biggest driver of the economy and the markets, and in fact, the biggest impact in our lives for the last 18 to 24 months. The first consequence is inflation. Inflation is certainly trending higher, but the Bank of Canada and the US Fed still call it transitory or temporary. The question is it really? Everything seems to be going up. And Canada's CPI, which measures consumer price inflation, was up 4.7% in October, the biggest increase since 2003. Core CPI, which excludes food and energy costs because they are too volatile, and it's not like we don't use it, they rose 2.7%. Now, the central banks always look at core CPI rather than overall CPI. But in the US, CPI had the biggest jump in 30 years in October. Core CPI was 4.6%, and the headline number, or overall CPI, was 6.2%. So quite high. So what's the impact of this been on bond yields? Bond yields are normalizing and getting back to pre-pandemic levels, but they still remain stubbornly low, which suggests that investors are really not concerned about rising inflation. The 10-year Government of Canada bond yield was today at 1.77%, which is up 12 basis points in just the past month. But that compares with 1.7% at the beginning of 2020, just before the pandemic hit. The US 10-year Treasury yield is at 1.65%, and that's an increase of 2 basis points over the past month. And that's still a little lower with the 1.92% it was at the beginning of 2020, just before the pandemic. The next point is balance sheets. Now, corporate and household balance sheets are in surprisingly good shape. And I say surprisingly because when you come out of a recession, you usually get a hit. People take on more debt, companies take on more debt to survive. But thanks to record earnings and stimulus payments and the wealth effect that people feel from higher markets and higher stock prices, total debt as a proportion of equity or net worth is quite manageable. So the fact that balance sheets are in good shape is a very good thing. Next, the housing boom, totally unexpected. So amid the worst pandemic in a century, housing prices surged to record levels in Canada and the US. And it's no wonder that in Vancouver, everyone's talking about real estate all the time. The next impact is on markets, which have been relentlessly hitting new highs because of the strength of the economic recovery and the strength in the rebound in corporate profits. The S&P has posted 66 record highs this year alone. Now, the labor shortage. It's an unusual development because people are quitting the jobs in record numbers. As a result, there's an acute labor shortage in North America. And economists are not sure about the exact reason, but it could very likely be a combination of a number of things. COVID fears, stimulus payments, the wealth effect caused by record housing and stock prices, early retirement for some lucky people, and I'm sure there's a few of you in that group, childcare issues for young families. It's a long list, but what it means is all this is contributing to people quitting their jobs in record numbers and an acute labor shortage. Then we have supply chain constraints, which we've talked about. Many factories shut down in 2020. There were huge production cutbacks. But now, because demand has surged so much, you're having massive supply chain shortages in so many sectors. And this is not going to get over anytime soon. So what does this tell us? The most important thing, interest rates. When you put all this together, rising inflation, labor shortage, supply chain problems, you might think that the central banks should be raising rates imminently, but no. Neither the Bank of Canada nor the Fed seem to be in any hurry to raise interest rates. And last month, actually, a Scotiabank economist caused quite a stir by predicting four rate hikes by the Bank of Canada in the second half of 2022 and 4 more in 2023, which would take the benchmark rate from about 0.25%, where it's right now, to 2.25%. Can you imagine the impact that would have on the housing market? But fortunately, this is a minority view. And the street consensus is that rates, both in the US and in Canada, will rise, but not that rapidly. So how does this impact your portfolio? This is what we think. COVID-19 is still a wild card. If you look at the chart on the right, it shows you global COVID cases, and it shows that we may actually be approaching a fourth wave. So COVID remains a potent threat. The question is whether there's a possibility of an emerging super strain, something like Delta Plus, coming out in 2022, or will the pandemic really be in the rearview mirror in 2022? It's really hard to say right now. We hope it's the latter. But that said, whatever happens with COVID, full-blown lockdowns are very unlikely. Governments are tapped out, they have no more money to spend on stimulus, and work from home has succeeded beyond expectations. So, and the fact is that most current cases in North America are among people who are not vaccinated. So as long as ICU caseloads and deaths are under control, it will be the new normal like we are seeing at present. You can also expect higher volatility in 2022. The past 12 months have been an anomaly in the sense that there have hardly been any significant pullbacks, but that should change next year. Also, brace yourself for lower returns going forward, given that stock markets are already at record highs. Corporate earnings have probably peaked because all input costs are trending higher. Labor, raw materials, capital, transportation, the cost of everything is going up. So that means that profit margins are going to come under pressure, and that means that companies might earn less going forward. And as we discussed, bonds will be under pressure from rising interest rates. So all in all, brace yourself for lower returns. Continue to stay diversified. The S&P 500 outperformed the TSX almost threefold in the past decade. So from 2011 to 2020, the TSX returned 5.75% annually, but the S&P did 3 times as much, 16.7% per annum in Canadian dollar terms. Now we think that picture could change in the years ahead partly because the biggest US tech companies that have driven much of the US market, what we call the FANGs, Facebook, Apple, Amazon, Netflix, Google, and so on, they are facing challenges to their market dominance on a number of fronts. Also, higher inflation, rising inflation benefits the TSX because of its weight in financials and commodities. But at the same time, it hurts the tech stocks that are very dominant in the US, especially the ones that are not profitable. It hurts them more because of the impact of higher rates on future earnings. So the conclusion is that we think the TSX should do better in the coming decade. And as Canadian investors, obviously, that's a very good thing for us. Next point, seriously consider the impact of higher interest rates on your full portfolio, not just what you hold at Luft Financial, but also look at what you hold in investment real estate. I find that there are quite a few risks in terms of people. You're hearing all sorts of anecdotal evidence about cash bids for houses and multiple bids. It might have slowed down a little bit in recent months, but the fact remains that there are hidden risks in investment real estate which investors don't realize at present, and it could be a huge thing in the years ahead. So really consider the impact that higher interest rates will have on all aspects of a portfolio. And finally, reduce leverage, because the days of easy money are coming to an end. So in conclusion, 2021 has been a great year for the markets, but brace yourselves for higher volatility and lower return over the next couple of years. So based on strategic targets, we think double-digit returns in the low to mid-teens are possible for the TSX and the S&P 500. COVID-19 will continue to be a wild card in 2022. Consider the impact of higher interest rates because they are coming. Those rates are going to go higher. And finally, based on a most recent review, and when I say our review, I'm talking about our portfolio management team at Luft Financial, which is Robert, Aaron, Zoe, and myself. We had a review in the first week of November, and we think that we'll get stable returns in 2022, but there's a possibility of higher downside risk. So at the present time, we are leaving our asset allocation unchanged, but we will make dynamic changes as warranted in 2022. Thank you all very much for your time. I'll now turn it over to Robert. Thank you.
Thanks, Elvis. That was excellent and very uplifting.
Always a pleasure.
You can stay on the call with us here. So what I want to get a sense of now, we can bring everybody back and probably end the slideshow and open it up for some questions. I'm interested to see what everybody is thinking now that they've sat through those two separate parts of the presentation. So feel free to post your questions now, and then we can hopefully answer them in an open forum. And maybe I'll just stop the slide presentation so that we're all bigger. There we go. So does anyone have any questions, first of all, for the team? Now that we're all here in one spot, it's a great way to pick our brains. Based on anything you've heard today, I encourage you to post that to the chat so that we can probably answer it verbally. Let's see, any questions? We haven't had any questions on the chat for quite some time. So either we've put everybody to sleep or we answered all their questions, which I doubt either of those to be the case. If we don't get any, then I might start just rattling some off just to pick on us or pick on people.
Well, just to follow up on it as well is that, we know whenever we do these webinars, seminars, we always give you lots of information. And, if you weren't able to take it all in and you have questions later on, we'll always review it, cover it during our meetings. We're always here to answer these questions anytime as well. So if you have a question tomorrow, next week, whenever, just reach out to your advisor. Zaw, Elvis, we can all answer and help you.
I like Jeff's. That's an interesting one. Is there a hierarchy amongst fund managers and end sayer, and how is conflict resolved? Jeff, could you be more specific? Do you mean in our internal portfolio management committee, or do you mean within the funds we've selected for the Platinum Growth Fund? So maybe while Jeff is... Yeah, I'll answer Lori too.
Yeah.
Or Elvis, answer Lori's question.
Yeah, sure. So Lori, with regard to your question, we will continue to hold Visa. We will continue to hold the individual stock positions that we hold in our bigger portfolios. And speaking specifically of Visa, we really like the stock. We think it's a buying opportunity here. We've seen in the past that when there's any kind of conflict with Amazon, that tends to hit stocks really hard. But we love Visa for the long term. And all the individual stocks that we own in our portfolios are kind of best of breed. So we continue to look very actively for opportunities both to sell, take profits in some of them, or buy something else. But that's not going to change. We will continue to hold individual stocks in our portfolios.
Sorry, I'm still not clear on Jeff's question. Are you guys? Whether he's asking, if he's asking the
No.
fund managers inside of our Platinum Growth Fund, or if he's asking the portfolio manager at Luft Financial. Here's one of the things I would like to address, because clearly we didn't do a good job of explaining it, because the question kind of came up in a number of different ways. The Platinum Growth Fund is only replacing the mutual funds that were active stock funds within your portfolio. So I'm going to share my screen, just show you guys quickly what I mean by that. Let me know when you can see it. Okay, so here, for example, is probably our largest model portfolio. Many of you would recognize this, the pension portfolio. This is our big balanced growth portfolio that's made to look like a pension plan. In the past, it had a large number of individual equity managers. Those have been replaced by a 20% allocation to the Platinum Growth Fund. It still includes our bond holdings, our top stocks, our fixed income pool, our ETFs, our private real estate, our private mortgages, and our Canadian bond market. So remember, we're just explaining a sleeve inside your overall model. So there's the model portfolio you still have based on your risk tolerance. And this is just a nice little sleeve to replace a whole bunch of positions in one. Maybe that should have been something that we explained better. Somebody want to answer Andrea's? So you want to take a shot at Andrea's question?
One second.
So to answer Andrea's question, the fund incurs a lower management fee. Yes, it does. And that's because, as Robert mentioned, by using the institutional series for most of the funds, we've got a substantial discount. There's also a little bit of a cost for running the overall fund, but net-net, the cost is very little change from what we were paying previously. The management fee that Luft Financial charges is a separate issue altogether, and that's not going to change. Robert, you want to add anything to that?
Yeah, I get a sense that what she's asking is, so inside the bucket, those, if we kept those funds separate, just keep it really simple, they would charge us in general more. When we have it outside the bucket, they charge us more. Inside the bucket, they charge less. So we were already all paying. Like if we had Dynamic Power American Growth before, the embedded cost in that fund might have been 1%. And we hold it across 1,000 accounts. Now we hold it in one account, the Platinum Growth Fund, and that entire 10 to 15 million is in one account. So now they might charge us 0.8%. When you run a fund, there's internal costs charged by the administration of that fund that are now more than offset by the fee reductions that we get from those internal managers. So as our fund gets bigger, we continuously get a savings for you as a retail client. And we don't charge anything to that fund. Remember, we're only being paid the management fees that you're charged directly. Is that maybe just a reiteration? But does that make sense? Does it make sense to everybody, all the advisors and PMs that are on the call?
Yeah.
Okay. Lori, I'll answer your question about DRIP. When we run a model portfolio, think of all those different holdings we have, individual stocks, ETFs, and funds. They're all constantly creating income inside our pool. We want to control what happens to that income, so we will reinvest it when we rebalance. So Elvis, for example, has a maximum target on how much cash can be in any one of our models. And as soon as that cash reaches a threshold, he'll rebalance everybody's accounts at once. So we don't necessarily want the dividends because you're ambivalent to price. Trips were really great in the sense where, you had a stock, you don't have to be buying more of that stock and paying commissions when you receive the dividend. That doesn't happen in our accounts. So we control when there's distributions, which portion of your portfolio those distributions go to.
And primarily, most of the investments in the fund are not funds that pay dividends or distribute more than annually, for the most part. We kept a lot of those eligible Canadian dividend funds, like preferred shares, outside of this pool.
Yeah. Elvis, you want to take a shot at Dion's question?
Yeah. I was just saying, Dion, we think that I know there's been a lot of concern about what's going to happen to copper prices, oil prices, and so on. So the reality is that there was severe, even before COVID, there were massive cutbacks to oil production and base metals and mining capacity in the 4 or 5 years after 2015 or 2016, once the commodity and energy bubble kind of burst. So that means that there's a global shortage of these things, and we know that people have been talking about a long time about the impact of electric vehicles, for instance, on crude oil demand. But this just shows you that when the supply-demand equation goes out of whack, the impact can be very swift. So I think crude oil, for example, still has upside. I think the global economy, given that the projection is for 5% growth next year, it's still on a solid track for base metals like copper and other things. So overall, we think next year should be positive for base metals and for energy. But the caveat here is that unlike 2021, where it was pretty much a one-way street, you're going to see much more volatility.
Just quickly take Ryan's. Ryan Ozing asks, so we net out ahead on fees plus the benefits of the accounting? The answer is yes. That's why we did this. In anything where you aggregate, you hope to get a discount. So the other portfolio managers wouldn't give us a discount if we, like I said, if we held their fund in 1,000 accounts, they treat it like 1,000 separate holdings, even though we're buying a fee class version of their fund. Now we get a special institutional version, and we're like big dogs at the party now, like running a pension plan. So that allows us to simplify your accounting and have all of your active managers in one sleeve. I want to get something kind of clear here, that alluding to what Elvis talked about as far as volatility. This is the active, in other words, there's managers running each of these funds, portion of your portfolio. If the stock market drops 20%, the underlying holdings of this fund are not going to drop 20%. They're probably going to drop 16 or 17, but they will drop. These are managers that we found to buy and sell stocks in a specific section of your portfolio. So this is going to be one of the more volatile areas. This is the stock exposure you have. If we do not get a 10% pullback in the equity markets within the next 12 to 24 months, I would be shocked. So Platinum Growth Fund will go down 7 to 8% because it's 100% stock based. The other areas of your portfolio, according to your IPS, your investment policy, the risk you've chosen, those will hold up more, like the income, the mortgages. But when when we look out 12 to 24 months and say, okay, we're looking at the equity markets being positive, that isn't 13% like this. It's been quite funny to watch how from October of last year to the beginning of September, everybody was very happy. You know why you were all very happy? Because we didn't have a single negative month. That's an anomaly. September hits, stock markets go down 4, our average portfolio was down 1.9, so half the risk of the markets. So any single month that the stock markets lose money, we are going to lose you money. We're just going to lose you less. There's no such thing as the equity markets going down 5% next month. Our win would be if we're down 3. And the Platinum Growth Fund is an amalgamation of a whole bunch of funds. So you don't want to go, oh, this fund's terrible, look, it lost 5%. If that fund loses 5% because it's got 9 other funds in it, it's because the stock market's down 7. So it is going to be a bumpy ride. I was asked this by a client yesterday, so I'll kind of bring it up today. You know, if you ask me what my 5-year expectation is from here, I think in our balanced growth portfolio, so that's our mandates that have 60% equity exposure and 40% income, you're going to average 5 to 6%. That's it. Okay, inflation's going to be ugly. All these changes are happening. 5 to 6% average, and at least one of those 5 years, you're going to lose 10%. But in that year where you lose 10, the equity markets are going to be down 15 to 20. And it's TINA. Remember this acronym. There is no other option.
Alternative.
Alternative.
Tino. Tino is option.
Yeah, Tino. It's a Tino. There is no other option or alternative. Yeah, Tina. Sorry. Thanks, Elvis. But what are you going to do? You're going to put it into Tangerine. You'll get positive returns every month, but you will not keep up with inflation.
I think Dale's got a question on interest rate hikes and tapering. Very good question. So there was a little bit of controversy in the last few weeks about the next Fed chairman. And I think it looks like Biden has now nominated or shown his support for Powell. And I was looking at a headline today which said that, interestingly, people now think that inflation in the US in the years ahead will not be an issue. It's really hard to say. I mean, the fact is, as I mentioned earlier, central banks still think that this is a temporary problem. We'll probably know in the next year or two if it's a temporary problem or something that's more insidious. The prospect of a significant market correction, so our portfolio management team thinks that it's possible. We may get a 10% pullback sometime in 2022. Mind you, we've not had a 5 or 6% pullback for the last 12 to 14 months. So this one is just like an earthquake. It's a little bit overdue. In terms of a rebound like in 2008 or 2020, Dale, I presume you mean a rebound like when you had a market bottom. That's already happened. You've seen this big surge. You've seen the markets double from the March 2020 lows. So the overall trend is still positive. Earnings are still going up. So if you get a 10% pullback, you can rest assured we'll be in there buying because we think the markets will rebound from that dip.
Do we miss anyone? Any questions? I think we've gotten to everyone.
Yeah, I think so.
Yeah.
Okay, can I take this one from Andre?
Sure.
Yes.
So I think, Andre, you're familiar with most of our models, but
Andre. And you can send it to him. We can send them the PDF too.
From conservative to aggressive, the conservative one would be protection. Balanced growth is what we call a pension model. Growth is what we call a pursuit model. And the high growth one is prosperity. And if I'm not mistaken, I think Andre owns pursuit and prosperity.
Yeah, Andre, the other thing too is we can send you, we've got a really good document. If maybe Zoff, you can make a note to send that to Andre again, our PDF on the Luft financial models. So anybody that wants that, if they forget, we have a nice document that summarizes the models that we manage and the different risk levels. And remember, Platinum Growth Fund is just a holding within each of those models. So if you need that summary or you want that summary again of all the different models we manage, it's easy to send you a link to that. Okay, doesn't look like there's a lot of other questions. Okay, give it a couple more seconds, I guess. And, I think that's great. It's a good summary. Well, if you think of something after the webinar is over, we, as Aaron alluded to, just fire your lead advisor the question or send it to the portfolio management team, and we'll be sure to get you the information you need right away. Again, just to reiterate what we said at the beginning, it'd be great if we could get some feedback from you directly. I'd be really interested to see which topics you'd like to see. Personally, I'd like to see, with the way COVID has gone, I thought this would be over a lot quicker than it has been, and we'd be back to seeing people. It doesn't look like that's going to be the case, so this is a great way to communicate to everybody in a forum quickly on a variety of topics. So we have been doing these live presentations in person for some of the companies and employers that we work with. But for our clients, if you guys want to see more of these, please reach out to your advisor, reach out to us, let us know the topics you'd be interested in, and we can put these up really quickly. And it's great because we don't have to rent a room at the Terminal City Club for 15 or 20 grand, and we can probably do one of these every single month if that's something that you're interested in. Okay. So hopefully everybody found it beneficial. I know we enjoy doing them. It's tough to not see all your faces, but it's tough to teach to a camera, right?
Yeah.
But we'll like to thank you, and we'll sign off. We'll sign off now. So thank you everybody for attending today.
Thank you.
Great job,
Thank
all
you.
the speakers and the question and answers, and thanks to the team.